Hello and welcome to topic 6 in advanced financial accounting, business combinations. This is Harjinder. Business combinations. Essentially, a business combination is a transaction or some other event in which an acquirer, a company that is seen as having acquired another company, an acquirer obtains control of one or more businesses. Now, the acquirer may obtain control of an inquiry in a variety of ways. For example, by transferring cash, cash equivalent, or other assets, by incurring liabilities, by issuing equity interests, so shares of its own, by providing more than one type of consideration, or without transferring consideration, including by contract alone. This is taken from IFRS 3, paragraph B5. Business combinations may be structured in a variety of ways for legal, tax, or other reasons, which include, but are certainly not limited to, one or more businesses becoming subsidiaries of an acquirer, or the net assets of one or more businesses to be legally merged into the acquirer. So that's one way. One combining entity transfers its net assets, or its owners transfer their equity interests to another combining entity or its owners. So it could be that could happen, a merger of sorts. All of the combining entities transfer their net assets, or the owners of those entities transfer their equity interest to a newly formed entity, and that's called a roll-up or put-together transaction. Or a group of former owners of one of the combining entities gets control over the combined entity. So these could be different ways in which a business combination might be affected. We will be looking at the more common ways, and that includes purchase of net assets, purchase of voting shares to obtain control, and obtaining control through contractual means. So it's important to keep in mind that a business must be taken over. So what's the definition of a business? A business consists of inputs and processes that are applied to those inputs that have the ability to contribute to the creation of outputs. So 3 elements of business are defined as follows. There must be inputs. So any economic resource that creates outputs or has the ability to contribute to the creation of outputs, and one or more processes are applied to it. There must be some kind of process, system, a standard, protocol, convention, a rule that, when applied to an input or inputs, creates outputs or has the ability to contribute to the creation of outputs. Finally, there's an output. The result of the inputs and processes that are applied to those inputs that provide goods or services to customers, generate investment income, or generate other income from ordinary activities. So basically, a business should have these elements, that there should be resources that are contributed towards the generation of the outputs. And that output could be goods or services. That's the more common way of looking at a business. But you also have companies that engage in investing. So investment houses, they identify possible investment opportunities. So that'd be the processes. The input would be the money that is invested, and then the output is basically the revenue, the income generated from such activity. So why would I mention this? A business combination requires that a business must be combined, right? So it can't be simply just a bunch of assets being taken over, because a bunch of assets by themselves will not contribute a business. You have to make sure that there is a business that is being combined. Why will companies engage in a business combination? Some reasons that might be involved is to possibly defend or build on a competitive position, right? You want to thwart off a competitor, so just take over that competitor. You may be looking to diversify into a new market or to a geographic region, right? So that could involve, Canadian companies looking to expand into Europe. Maybe a quicker way to get access to the European market might be to acquire a European company that is already established, because it can speed up the process, the regulatory process. So that might be a reason. Or we may be looking to access new customers, products, or services, expertise, or capabilities. For example, technology. So Nokia used to be a cell phone manufacturer that was a very famous brand some 20 years ago. Things fell apart for Nokia, but Nokia had a lot of patents. So I believe Microsoft went ahead and purchased Nokia specifically for its patents. So that might be a reason for a business combination. How do we account for a business combination? As far as IFRS 3 is concerned, an entity shall account for each business combination by applying the acquisition method. Applying the acquisition method needs the identification of the acquirer. So who acquired whom, determining the acquisition date, when did the acquisition take place, recognizing and measuring the identifiable assets acquired, the liabilities taken over, and any non-controlling interest in the acquiree. If the acquirer does not own 100% of the acquiree, then there might be a non-controlling interest, other owners that do not have a controlling stake, and recognizing and measuring goodwill or a gain from a bargain purchase. We will be talking about these in more detail later on. So how can a business combination be achieved? There are three basic ways in which a business combination may be done. Number one, through the purchase of net assets of the acquiring company. Number two, acquisition of control through the purchase of voting shares of the acquiring company. And number three, acquisition of control through contractual arrangements, such as setting up a special purpose entity or a variable interest entity. So first off, purchase of net assets. So what happens here, you have two companies, company A, company B, and they're separate companies in their own right. Company A has got assets, liabilities, and equity. Company B has assets, liabilities, and equity. So say company A purchases the net assets of company B for $40,000. And for the sake of simplicity, we're assuming that book values equal fair values and there were no transaction costs. We will be dealing with these later on, but for now, just to maintain simplicity. Company A buys the net assets of company B. So the purchase of net assets means company A has actually acquired all of the assets and has taken over all of the liabilities belonging to company B. So the assets and the liabilities for company B are taken over by company A. Notice that the assets of company B are now added to the other assets of company A, the liabilities of company B are now added to the liabilities of company A. And company A has transferred cash, so the cash balance for company A went down, and that cash is now sitting on the balance sheet of company B. The two companies continue to exist after the fact, but notice company B does not have any operating assets left other than the cash. The company B is essentially a shell of a company. All of its assets, all of its liabilities are now assets and liabilities belonging to company A. Okay, so that is purchase of net assets. So how do we account for a purchase of net assets? The acquirer company will recognize all of the assets and liabilities of the acquired company at fair value. Any transaction costs, such as professional fees, are expensed as incurred. Now, if the acquisition is made by issuing their own shares, any share issuance costs that are incurred by the acquirer company are to be capitalized. So to capitalize share issuance costs here means subtract the share issuance costs from the book value of the common shares issued. Any difference between the purchase consideration and the fair value of the net assets is recorded as goodwill. If the purchase consideration is more than the fair value of the net assets, the difference is recorded as goodwill. If the fair value of the net assets is greater than the purchase consideration, then the difference is recorded as a gain on acquisition. Thing to keep in mind is if there's any existing goodwill on the books of the acquired company, it is not recognized by the acquirer. So any pre-existing goodwill is excluded from the transaction. Next, let's take a look at control. So what does control mean? This is defined in IFRS 10. An investor, regardless of the nature of its involvement with an entity, the investee, shall determine whether it's a parent by assessing whether it controls the investee. So the investor has to assess whether it is able to exercise control. IFRS 10 does not apply in situations where two or more entities jointly control an investee. So if that were the case, then that would be a situation of joint ventures or joint operations, which we looked at in the earlier topic. Or if no investor controls the investee, in that case, IFRS 9 will apply because it'll be a passive investment. An investor is said to control an investee when it is exposed or has rights to variable returns from its involvement with the investee and has the ability to affect those returns through its power over the investee. So that then leads us to a few characteristics of control. An investor may be said to control an investee if and only if the investor has all the following. Number one, it has power over the investee. Two, it has exposure or rights to variable returns from its involvement with the investee. Variable returns basically indicates profits, losses of the investee. So it could lose money or it could make money from its involvement with the investee. Those variable returns are important. And C, the ability to use its power over the investee to affect the amount of the investor's returns. Now, something that you folks must keep in mind is that the variable returns come from the involvement of the investor with the investee. So it's not a passive scenario. All right. In passive situations, in passive investments, the investor will buy shares or some other financial instrument issued by the investee company and then do nothing essentially, right? Because all they are getting is dividends or interest income. The investor company does not direct any actions at or direct any major activities at the investee's side. Control may be acquired through the purchase of common shares of the investee or a contractual arrangement by which one company becomes the primary beneficiary in another company. And that's other companies called the special purpose entity. Non-controlling interests is basically equity in a subsidiary that is not attributable to the parent, either directly or indirectly. And these include the common shareholders or preferred shareholders of the subsidiary other than the parent company, and shareholders of a variable interest entity other than the primary beneficiary. Now, keep in mind that it may be possible for another investor to exercise significant influence over the investee. So the investee may be controlled, and yet it may be possible for another investor to exercise significant influence. Think about Warren Buffett, Berkshire Hathaway. If Warren Buffett takes so recently Warren Buffett acquired a portion of Barrick Gold. I'm sure Barrick Gold's board of directors will pay attention to what Warren Buffett and his representatives from Berkshire Hathaway have to say about Barrick Gold's operations, because, of course, Berkshire Hathaway is such a big name. It carries weight. And so Berkshire Hathaway, therefore, should be able to exercise influence over Barrick's operations if they choose to. Accounting for controlled entities. A parent shall prepare consolidated financial statements using uniform accounting policies for like transactions and other events in similar circumstances, as IFRS 10, paragraph 19, except if the parent is an investment entity, in which case the investment will be accounted for as fair value through profit or loss in accordance with IFRS 9. That's paragraph 31. So what's an investment entity? It's an entity that obtains funds from one or more investors for the purpose of providing those investors with investment management services, commits to its investors that its business purpose is to invest funds solely for returns from capital appreciation, investment income, or both, and measures and evaluates the performance of substantially all of its investment on a fair value basis. So I was mentioning Berkshire Hathaway. If Berkshire Hathaway basically limits its activities to investment management and measures and evaluates the performance of all of its investments on a fair value basis, then it can claim to be an investment entity and therefore will not need to, even if it had controlling interests, it will not need to prepare consolidated financial statements. Let's take a look at acquisition of control by the purchase of voting shares. So just like we saw for the purchase of net assets, two companies here, company A, company B. Company A is owned by shareholders of company A. Company B is owned by shareholders of company B. Company A buys the common shares of company B for $40,000 and ignore transaction costs, assume that book values equal fair values. The consequence of this transaction is different from the consequence of purchase of net assets. Here, what happens is, notice that on the books of company A, there's now an investment in company B account. Cash went down. And the ownership in company B has changed. Now company B is owned by company A. The former shareholders of company B have been replaced by company A. Otherwise, the two companies will continue to exist in the eyes of the law. They'll continue to earn their own income and file their own income tax returns, et cetera, et cetera. However, given the fact that company B is now owned by company A, B has become the subsidiary of company A. And so what company A needs to do now is prepare consolidated financial statements, including company B's financial information. So control through purchase of common shares, a little bit more. When a business combination occurs through the purchase of a majority of voting shares, common shares basically, consolidated financial statements are required to report the combined financial position and results of operations of the parent company and the subsidiary. The parent is the company that controls, it's the initial investor, and the subsidiary is the controlled company. And the acquisition method is used for accounting for control investments. Under this method, any excess of the consideration paid over the fair values of identifiable assets and liabilities is allocated to goodwill. And in case there is negative goodwill, it is recognized immediately as a gain by the investor. Looking at acquisition of control through contractual arrangements. So here's a scenario. There's company A, company B. Company B seems to be in a little bit of financial trouble. It's got negative equity balance. Its liabilities exceed its assets. Company A seems to be in much better financial situation. So what may happen here is company A agrees to guarantee the liabilities of company B. So that can help allay fears of possible bankruptcy on the part of creditors of company B, and also provide shareholders of company B with a guaranteed dividend. In return, company A will have rights over company B's future profits. So this is basically a contractual arrangement where nothing changes as far as the balance sheets are concerned, but de facto, company B becomes controlled by company A. Company A has not taken an equity interest in company B. Company A does not own shares of company B, although it is possible that company A might have owned some shares. Like we don't discount that, but this contractual arrangement that we're seeing did not require company A to do anything like that. All that company A did was say to the creditors of company B, hey, you guys don't need to worry about the security of your money. We will guarantee, we will provide guarantee for the liabilities. And then to the shareholders of company B, company A says, we'll give you folks a guaranteed dividend, but any sort of variable returns in future, the profits of company B in future will now belong to company A. So that is a situation where there is obtaining of control by company A over company B through a contractual arrangement. When a company gets control through contractual arrangements, the acquirer shall attribute to the owners of the acquiree the amount of the acquiree's net assets recognized in accordance with IFRS 3. In other words, the equity interest in the acquiree held by parties other than the acquiree become a non-controlling interest after the this arrangement has been implemented. In the acquirer's post-combination financial statements, even if the result is that all of the equity interests in the acquiree are attributed to non-controlling interests. So basically, the acquirer of control becomes the party that has to prepare consolidated financial statements, and the shareholders of the variable interest entity essentially are relegated to the position of NCI, non-controlling interest. So variable interest entity, also called special purpose entity, is an example of how a company may obtain control through contractual arrangement. The company that obtains control is called the primary beneficiary. Or another word for that is sponsor. The sponsor must consolidate the financial statements of the VIE. So what's the basic setup here? The existing common shareholders of the variable interest entity are considered non-controlling interest. The value of the investment of the non-controlling interest is negotiated, and NCI receive a guaranteed return from the sponsor. So that was where Company A was guaranteeing an amount of dividend to the shareholders of Company B. The debt of the variable interest entity is also guaranteed by the sponsor. So basically, Company A assumes the de facto role of the parent. All the debt of the subsidiary is guaranteed. The non-controlling interest is guaranteed a rate of return. And then basically whatever are the variable returns from the VIE will then belong to the sponsor. All right, let's take a look at consolidation. So the basics of consolidation here. When one company has control of another company, the two companies combined are considered to be one economic entity, although they remain two separate legal entities. And the reason for this is because the parent controls the business activities or strategic direction of the subsidiary. And for reporting purposes, the two companies are therefore considered to be one. In addition to adding the two separate sets of statements together and reporting the combined figures, consolidation calls for adjustments to be made to the assets and liability values at the date of acquisition date, and also consider the effect of intracompany events that may occur between the two companies. Consolidation begins from the date the investor obtains control and will stop if the investor were to lose control over the investee. And that's according to paragraph 20 of IFRS 10. Consolidation on the date of acquisition will call for 3 steps. Step 1 involves identifying the acquirer, the acquisition cost, as well as the value of non-controlling interest on the date of acquisition. Step 2 calls for calculating acquisition differential and goodwill, if any. And then once you've done these calculations, you can go ahead and prepare a consolidated statement of financial position or a consolidated balance sheet. So when we prepare the consolidated balance sheet, the investment account and the shareholders' equity of the subsidiary get eliminated. So on the consolidated balance sheet, we do not report the investment account related to the subsidiary, and we only report the parent company's shareholders' equity. Take a look at the first step, identifying the acquirer. Under IFRS 3, the acquirer needs to be identified, and there's some guidance included in IFRS 10 on how to determine this. It's basically the acquirer is the party that obtains control. Now, in most cases, business combinations are done by transferring cash or other assets or by incurring liabilities. So if that were the case, the entity that paid cash or other assets or incurred liabilities for the shares will be seen as the acquirer. Sometimes, though, the business combination is effected by exchanging shares. So in that case, again, the acquirer is usually the entity that issues new shares. However, this is a potentially tricky area. It is possible that the way in which the combination is structured could result in a reverse acquisition or reverse takeover. So what's a reverse takeover? This happens where the legal acquirer, the company that for legal purposes is seen as the acquirer, ends up issuing proportionally more shares to the shareholders of the legal acquiree. And the result then is that the shareholders of the acquiree, the legal acquiree, have more voting rights in the combined entity. So what's the setup there? Let's say company A and company B both have 100,000 shares outstanding before the share purchase is done. Company A issues 150,000 shares to the shareholders of Company B in exchange for the shares of Company B. So after the share purchase is done, Company B will still have 100,000 shares outstanding, and these will now be owned by Company A. Company A, on the other hand, will now have 250,000 shares outstanding. Out of the 250,000, 100,000 will be owned by the shareholders of Company A before the business combination, and 150,000 shares, which will now be owned by the former shareholders of Company B. So if you take a look at the proportional amount, 150,000 is definitely more than 100. So the former shareholders of Company B now own a majority of the common shares of Company A. So essentially, Company A is now controlled by the former shareholders of Company B. So that's what a reverse takeover or reverse acquisition looks like. Also, as part of step one, we must identify the acquisition cost. So the acquisition cost consists of any cash paid, the fair value of assets transferred by the acquirer company, the present value of any promises by the acquirer to pay cash in the future for the combination, the fair value of any shares issued, fair value of contingent consideration. We'll talk about contingent consideration soon. Any professional and legal fees must be expensed. Any stock issuance costs are not expensed, but rather the book value of the common shares is reduced by the amount of the stock issuance cost. So basically, stock issuance costs are capitalized against the common shares. Contingent consideration, it refers to any additional payment, could be in cash or through an additional issue of shares, which depends on some future specified event. Under IFRS 3, contingent consideration must be recorded at the date of acquisition at its expected value. So you must include some probabilities in calculating the expected value. If there's a range of potential payment, then that must be disclosed. The contingent consideration will be classified as a liability or equity, depending on whether it'll be paid out in cash or by issuing shares. So if the contingent consideration is payable in cash, then it'll be a liability. If it were to be settled by issuing additional shares, then it will be considered a portion of equity. In cases where the contingent consideration's been classified as a liability, changes in the amount are reported through net income. And there is no change in the common shares book value in case there are changes in contingent consideration that was originally classified as equity. Now, the acquisition cost in the case of a reverse acquisition or a reverse takeover, the acquisition cost is calculated as follows. If the acquirer is a public company, we must calculate a notional number. So no shares will actually be issued, just the notional number of shares that would have been issued by the reverse acquirer to achieve the same percentage ownership. So we looked at shareholders of company A, shareholders of company B. If you recall, the shareholders of company A had 100,000 shares, shareholders of company B had 150,000 shares. So that's a 40 to 60 split, 40% to 60% ownership. So the notional number of shares to be issued to achieve the same percentage ownership multiplied by the market price of the acquirer's shares. The acquirer here is basically the legal acquiree, keep in mind, yeah? If the acquirer is a private company, then the acquisition cost will simply equal the fair value of the acquired company's net assets. Third part of the first step, looking at non-controlling interests on the date of acquisition. So keep in mind, according to IFRS 10, an investor controls an investee when it is exposed to or has rights to variable returns from its involvement with an investee. And it has the ability to affect those returns through its power over the investee. So if the parent company does not own 100% of the outstanding voting shares of the subsidiary, the part of the subsidiary that is not owned by the parent is called non-controlling interest. A parent must present non-controlling interests on the consolidated balance sheet within equity, but separate from the equity of the parent owners. The parent company can choose two possible approaches to determine the value of non-controlling interests. They may use fair value or identifiable net assets of the acquiree. This is as per paragraph 18 of IFRS 3. So if we were to calculate fair value of non-controlling interests, if market trading prices are available, calculate the fair value of non-controlling interest using those market prices. If market prices are not available, then the fair value of non-controlling interest must be calculated either by using valuation models, using discounted cash flow techniques, or bring in a valuation expert and use the values determined by the valuation expert, or using consideration paid by the parent to impute the fair value of the subsidiary. And in this course, we'll be using this approach most often. Calculating non-controlling interest under the identifiable net assets method. So under the INA method, non-controlling interest is allocated their proportionate share of the subsidiary's net book value and fair value differences. We'll talk about later, but no goodwill. And so a direct calculation will simply involve multiplying the fair values of all the identified assets and liabilities, including any unrecorded ones, by the percentage share of NCI. If the subsidiary has preferred shares outstanding, well, then you have to keep in mind that preferred shares don't have voting rights. Now, if, of course, the preferred shares were convertible into common shares, then the potentially issuable shares must be included in calculations to determine control. But otherwise, preferred shares don't have voting rights. But keep in mind that preferred shares have preference over common shares in matters relating to dividends and in matters related to the final distribution of net assets if the company is wound up. So we have to keep the following points in mind. The net income available to common shareholders is net income minus the preferred dividends. If the preferred shares are cumulative and there are dividends in arrears at the time of acquisition, the amounts of the dividends and arrears must be deducted from retained earnings when calculating the acquisition differential. And a single year's dividend is subtracted regardless whether it is declared or not. In case the preferred shares have a liquidation premium attached to them, the entire amount of the liquidation premium must be allocated to the common shareholders because it'll come out of the common shareholders' equity portion. Now, keeping those points in mind, if the parent company does not own any preferred shares of the subsidiary, the entire amount of the preferred shares are considered part of non-controlling interest. If the parent company does own a part of the preferred shares issued by the subsidiary, then for consolidation purposes, we will consider them an intercompany investment and we will treat these shares as having been retired. So they end up being eliminated. Step 2, calculating acquisition differential and goodwill. It's important to keep in mind that the parent company will control 100% of the subsidiary, even if the parent company does not own 100% of the subsidiary. NCI, by definition, does not have any control. Non-controlling means no control. So if the parent company doesn't purchase 100% of the outstanding common shares of the subsidiary, the full value of the subsidiary is calculated by adding to the parent's acquisition cost the value assigned to non-controlling interest. The value of the subsidiary is made up of 3 components. Net book value, which is the shareholders' equity belonging to common shareholders, common shares plus the retained earnings belonging to common shareholders. Fair value differences of identifiable assets and liabilities. So if there's a difference between the fair value of assets and liabilities of the subsidiary and their book values, the differences are called fair value differences. And goodwill. Let's take a look at the calculation of acquisition differential and goodwill. We'll start with the acquisition cost at 100%. So that will include the cost paid for by the parent company plus any value assigned to non-controlling interests. So 100% of the subsidiary. From that amount, we'll subtract the net book value of the subsidiary, and that's basically the subsidiary's shareholders' equity. The difference between the acquisition cost at 100% and the net book value of the subsidiary's shareholders' equity gives us acquisition differential. This acquisition differential is allocated to fair value differences for all the identifiable assets and liabilities. Acquisition differential minus the amount for fair value differences equals goodwill. And it's important to keep in mind that goodwill cannot be negative. If you ever get a negative amount for goodwill, then that negative amount will be immediately recognized as a gain on acquisition. So goodwill, the lowest amount that goodwill can go to is 0. Goodwill cannot be negative. Take a look at the net book value of the subsidiary. So because control arises from the rights over relevant activities that affect the returns of the investee, to determine acquisition differential, we only use the common shareholders' equity of the subsidiary. Any existing goodwill on the books of the subsidiary must be subtracted from the net book value of the subsidiary when we calculate the acquisition differential. Acquisition differential is the difference between the value of 100% of the subsidiary and the net book value. This amount may be positive or negative. Doesn't matter. Regardless of whether the amount is a positive or a negative, we must proceed to allocate the acquisition differential to fair value differences of identifiable assets and liabilities. Fair value differences basically implies that the fair value of an asset or liability is different from its book value or carrying amount. The carrying amount can be overstated or understated. In case of unrecorded assets or liabilities, well, because there will be no book value, the entire fair value is understated. Now, the parent company is assumed to have paid fair value for the identified assets and liabilities. So if the assets are understated, the parent will have paid more than the carrying amount on the books of the subsidiary. And we can apply similar reasoning to other possible scenarios involving assets and liabilities. So when allocating fair value differences, understated assets are assigned a positive sign, they're debits. Understated liabilities, being credits, are assigned a negative sign. Overstated assets are assigned a negative sign, and overstated liabilities are assigned a positive sign. In order to remember how to do this, it's probably easy to make a 2x2. Assets and liabilities could be overstated or understated. Remember that understated assets are positives. So if you've got that part anchored, then the rest is basically complete a seating arrangement whereby you can put a positive next to another positive. So if understated assets are positive, overstated assets will be negative. Understated assets are positive, so understated liabilities will be negative, and therefore overstated liabilities will be positive. Goodwill is basically the difference between the acquisition differential and the total fair value differences. So acquisition differential minus the total of fair value differences gives us goodwill. Once again, goodwill cannot be negative. If the fair value differences total exceeds the acquisition differential, the negative difference is recorded immediately as a gain on acquisition. The gain on acquisition is included in retained earnings of the acquirer. The goodwill on acquisition is reported on the consolidated balance sheet. Now, I just want to point out that there is a difference between negative acquisition differential and negative goodwill. So you can have a negative acquisition differential when the implied value of 100% of the subsidiary is less than the book value of the subsidiary. But that's not the same thing as negative goodwill. You must still allocate the acquisition differential between fair value differences. And you may come across situations that the sum of the fair value differences is an even larger negative amount than the acquisition differential. And then therefore the difference between the acquisition differential and the fair value differences may result in positive goodwill. If, however, there is a negative amount resulting for goodwill, then that has to be recorded as an immediate gain on the consolidated income, on rather the consolidated retained earnings. So let's take a look at the relationship between NCI and goodwill on acquisition. If we calculate non-controlling interest using the parent's consideration, then the acquisition goodwill will be equal to that calculated in step 2. However, if non-controlling interest is calculated using the fair value of the subsidiary's shares on the date of acquisition or some other technique, then the amount of goodwill allocated to NCI will also differ. We will look at examples that will help explain this concept in class. For the time being, keep this in mind that there is a linkage between non-controlling interest and goodwill. For variable interest entities, goodwill is calculated by looking at the consideration given up by the sponsor, which is essentially carrying value of assets invested plus the negotiated fair value of non-controlling interest, and consideration received, which is carrying value of assets invested plus fair value of net assets of the variable interest entity. If the consideration received is greater than consideration, or sorry, rather the other way around, if the consideration given is greater than consideration received, the difference is goodwill. If the consideration given is lower than the consideration received, that would be a gain on purchase or gain on acquisition. And if the two amounts are equal to each other, then there will be no goodwill or gain. Finally, just take a look at step 3, the consolidated statement of financial position on the date of acquisition. The consolidated balance sheet is prepared in the name of the parent. If there were a reverse acquisition, the consolidated balance sheet will be prepared in the name of the legal acquirer. But keep in mind, the legal acquirer is the acquiree for accounting purposes. However, all of the calculations will be done using the legal acquiree, which is the acquirer for accounting purposes, as the parent. So although the name will still be the name in which the company's name for the statement of the consolidated statement of financial position will remain that of the legal acquirer. All of the calculations will be done using the accounting acquiree, the legal acquiree, as the parent company. Now, when making the consolidated balance sheet for each line item, we want to add together the carrying amounts of the parent and the subsidiaries' separate company balance sheet amounts after completing the acquisition transaction. We must eliminate the following. We will eliminate the investment in subsidiary account that would be showing up on the parent's balance sheet. We will eliminate the common shares and retained earnings of the subsidiary company, along with any existing goodwill on the books of the subsidiary company. And we must include fair value differences for the subsidiary company alone. We must include any goodwill arising from the acquisition calculated in step 2, and non-controlling interest where the parent company owns less than 100% of the subsidiary. In class, we will be going over a lot of examples, including examples concerning identifying the acquirer and the acquisition costs. We'll be looking at examples on contingent consideration. We'll be looking at examples on calculating NCI. And we will be looking at examples of a business combination effected through the purchase of net assets, consolidation on acquisition date, where there is a business combination effected through the purchase of shares. And also we'll take a look at a consolidated balance sheet where the business combination is effected through the setting up of a variable interest entity contractual relationship. So we are going to do a lot of examples in class. Thank you for watching this video till its end. I do hope that having watched the video, you will have some familiarity with the concepts that I will be referring to when going through examples in class. Okay, until then, bye-bye.